Good evening, everyone, and thank you for joining us for today for this event. I'm very happy to have Venu Gopal Mangat, who's a CIO for equities at HSBC AMC. And we have a slew of questions about markets. We had an eventful start to this year in 2025, and which has sprung a lot of surprises to the investors. And a very interesting anecdote is right now that letter T is defining the entire piece right now, which is Trump tariff and turbulence. However, beyond this short-term noise, there is something else as well. We have a very strong India is still focused on longs and long-term fundamentals are very strong for India. And another letter T defines that is thrive. So India is here to thrive. India is here to have a very strong long-term growth prospects. And we today have Venu Gopal Mangat to talk about that. Venu is the CIO for equities at HSBC Mutual Funds, over 2.5 decades of experience in equity markets. Without much ado, we will hand over to Venu to kick off on this his opening notes, and then we will have a very interactive session through various questions. And if you have any questions, you can type in on your question panel buttons, and we will be happy to take those questions as well. So, opening remarks from you, Venu.
Thank you, Manish. Good evening, everyone. This is a great opportunity for me to address all of you. Thank you so much for joining us today. Markets have been quite turbulent, as Manish mentioned. I think from September onwards, we've seen the end of the culmination of a strong bull market, and then from there on, we've seen a corrective phase. Over the last few months, it's been almost 5 months of consecutive decline for the indices. And even though most investors and everyone wanted a correction because it was, getting overheated and going just one side, the correction when it came has taken everyone by surprise, and there's no respite. It looks like, and it's just a sea of red every day that you see across most of the screens, be it large, mid, or small caps. And I'm sure you have a lot of questions on the prospects and what we think about these different segments. We will speak about those. But the view that we maintain here at HSBC Asset Management is that India is on a strong structural growth path, and we are compounding at close to 10% or in nominal terms in terms of GDP, and at 10% nominal GDP compounding, we will reach somewhere close to a $7.5–8 trillion GDP size from where we are today, which is about $3.8 trillion. So we are looking at doubling of GDP growth over the next 7 years or so, by 2030. And that, I think, is a structural run on the back of the strong reforms that we have seen during the last decade, and the recovery phase that we've seen post-COVID. I think the economy should continue to grow over the next few years at a reasonably strong pace. Now, during this phase of strong growth, there are phases of turbulence, as we have seen in the recent past. I think the calendar year 2025 could be a challenging year in that respect. And this is largely coming from the global side. During 2024, we've had the union elections, and that threw some surprises. Markets were not very happy with that, and then it moved on. Then, the monsoon fury in the second quarter slowed down the overall growth, and the markets expected the growth to come back in the second half of the year. That got belied, and so 2024 financial year, which is just concluding in a few days, has been a subdued year for the markets at least, and for the economy as well. And because the economy has been subdued, we've had the markets also behaving in that manner. Um, the year 2025 calendar year is likely to be challenging, as I mentioned, but a lot of the domestic factors, which I mentioned earlier, the elections and the surprises from there, the monsoon related issues, the capex slowing down, inflation remaining sticky, interest rates expectations whereof continuing at higher levels for longer. All of those are have got addressed, and I think the liquidity conditions have also improved meaningfully with the RBI taking significant action. So my view is that the negatives that were there for from the domestic side in financial year 24 have been addressed to a large extent. Obviously, we need to see follow up in terms of GDP growth. We've seen the December numbers, and should we need to see more of positive growth numbers going forward, and we should get back to a higher growth trajectory. But the negatives have got factored in, and have we have seen the worst already there behind us. From a global perspective, however, things are still looking quite murky, given the fact that we've had the a change in leadership in the US, and that is leading to a lot of uncertainty from a policy perspective, and that I think is going to play out for some period of time. The markets have not had not initially factored that in. I think more of that actually got into the prices only from the mid of January or beginning of this calendar year. My sense is this can continue for this calendar year or some period during this year, and which could therefore be an opportunity for investors to invest more in our markets, given that we have a very strong domestic economy, very thriving consumption based economy. And there are multiple pillars of growth for our economy and therefore for the markets as well, which therefore, we believe strongly that any corrections here on, I mean, we've seen some of the excesses already out of the system, and any corrections here on in the next few months should be used as an opportunity to buy into the markets, and people can put more money to work in this period, maybe through systematic plans or maybe a few installments during this next few months. So we are quite positive on the India story, and we believe this is a great opportunity with the correction that we have seen. And with that, I would like Manish to take over and ask his questions.
Yep. Thanks, Vinu. First question will be on US tariff policy. So obviously US has changed the complete tariff policy, and now they are importing a lot of inflation, which will have a lot of impact on their economy. But however, that is defining the global policy, global trade as well now. So what's your take on how this entire shift in US policy will impact the global economy and India in specific?
Yeah, this Manish is a little complicated topic given the fact that we don't still know exactly how things will play out, because these are announcements which are coming on a day-to-day basis. There are changes to the earlier views and earlier announcements. There's a to and fro because when there is a tariff announcement on one side, there's a retaliatory tariff on the other side, and then there is a change, and there is a delay in implementation. There is a date which is announced, and then that gets postponed. So I mean, there are too many variables, too many moving parts here. So it's not very it's not certain at all. There's no clarity on exactly how this is going to play out, which is a big negative for decision makers, given that uncertainty doesn't help in taking big decisions on projects and investments and and things like that, and therefore things slow down. So that's the impact of the initial phase. I think that's what's getting priced in currently. We will see post the implementation of the tariffs, if at all they are implemented, and how long they remain implemented, we don't know. But post implementation, we will then take a call on exactly how this is going to impact different geographies, different economies, and then how the supply chain moves and shifts, between each other, or to find alternate sources which are better, and how the consumer reacts, more importantly, because that's the most important part. As you rightly mentioned, some of this is inflationary, and let me just show you some charts which I have on this topic. While this is an evolving theme, we've put together what we understand and hear at this point in time on this, and which can possibly help investors understand this a little better. But as I said, this is evolving, and every day the views change, and you need to keep your thinking hat on all the time, as it changes. I think the starting point of this is probably the just one second. Yeah, the starting point of this whole topic of tariffs and is the fact that the US manufacturing as a percentage of GDP has been steadily declining over the last several years, probably close to 10-11% now of percentage of GDP. So I think there is clearly, with the leaders coming from a business background, there is clearly a view that manufacturing has to again pick up, and that should provide jobs for the in the economy, which is a very legitimate wish, and that should be pursued. So probably that is where it all started, and then obviously there are other theories, or which is that the US GDP. If you look at the US balance sheet, the debt is very significant, as you can see on the right hand side of this slide. Yeah, the current debt to GDP is at an extremely high level. So probably where it all started is to try and identify, or try and increase revenues by putting tariffs, and by doing that, address two things. One, improve the competitiveness of the local economy, the local companies, and therefore job creation over time. And secondly, get the revenues in. Along with that, cut down government expenditure, and that's what the DOG is doing, or is likely to do. And by doing both of these, improve the overall balance sheet significantly. And with the denominator increasing with the revenues and the GDP growth, the overall debt to GDP also will look better over time. So probably those were the reasons with which this whole topic or idea started. But the which is all fair. I think most economies, including India, would be doing similar things. We are looking to increase our manufacturing base as a percentage, manufacturing contribution to GDP, from 15% currently. I think the government wants it to take it to 25% over time. So I think that's a fair wish and fair goal to achieve, to target. But the only problem here is that when decisions like these are taken suddenly, and you have unilaterally, you take decisions like that, then there are repercussions. So like I said, the decision making across corporate America is expected to slow down. The growth forecasts are also now getting cut, given that there is a lot of uncertainty. Consumer confidence has slowed down. I think the recent data clearly is showing some weakness in the economy. So the left hand side chart is on the slide is actually Goldman Sachs report, which talks about their projection being cut for Q4. and going into 2025. Clearly, I think the earlier expectations of 2.5% growth in GDP is slowly getting cut, with the near-term pressures being more, and hopefully things stabilizing towards the later part of the year. But at this point in time, I think the general expectation seems to be that with these tariffs, the first impact is that growth is likely to come down. Uh, eh, eh, the Along with that, I think with the actions taken, the in US, with the DOG, has also or is likely to impact the labor markets, and that again brings down the overall growth in the economy. So as you can see, the US government was a critical support for the labor market recovery post COVID, and in the last couple of years. The private hiring rates are still quite weak, and that this government job creation is what the DOG is attacking, or is reducing. And to that extent, I think the expectation that the overall economy is likely to slow down with more unemployment numbers as we go forward. So I think this is one of the fallouts that we are already seeing some bit of that play out, and the data coming out reflecting that. Um, Here on this slide, you can see on the left-hand side a chart. You can see the consumption trends in the US. The Atlanta Fed nowcast is actually showing a sharp decline in US consumption for the March quarter. We will need to see how this plays out. And I think the inflation expectations have also gone high. This is household inflation expectations on the longer term. Clearly, with the talks on tariffs, and with the expectation that with the activities that the DOG is doing, I think there is increasing view that the overall GDP is likely to slow down. So these are effects of the U.S. economy, on the U.S. economy, from this whole discussion around tariffs and what the U.S. government is doing or is likely to do. Again, as I said, this is an evolving space. We don't know exactly how this is going to play out. There could be tariffs, there could be revisions to those tariffs, there could be counter tariffs, and so this needs to be watched carefully. This space. What we are showing here is currently is a view that is there currently in the markets, and generally accepted, which is what is playing out as we speak. So to my mind, what you're seeing on the S&P 500 or the Nasdaq is actually, of course, the valuations that moved up. There's been a lot of flow also into into that market, and again, there may be some excesses there which need to get corrected. But apart from that, I think the fears of a slowing economy, and is what is playing out today, and leading to a correction. On India, actually, it's not, to my mind, I think there are some positives as well for India. Indian government has actually been very proactive and been more positive to address this issue, with the Prime Minister being in the US, and I think the other ministers also now in the US, trying to address this upfront, and get into a deal, trade agreement with the US, upfront, so that you don't get into a messy situation later. So and I think if you look at the first of all, the percentage of exports from India to the US is very small, minuscule compared to what China or Mexico or Canada is doing. We are just about 2.7%, as a contribution to US goods imports from outside. Similarly, when you look at US exports into India, that's again just about 2% compared to a much higher number for the rest of the some of the large other economies, including China. So we're talking of a very small percentage for the US, and and therefore, my sense is that this is not likely to lead to a very significant battle between, in terms of tariffs between the two countries. I think this can be ironed out, and with the proactive measures that India is taking, should get addressed soon. Now, if you look at some of the goods, merchandise exports to the US, they are in segments like gems and jewelry, textiles, electronic goods, which is largely smartphones. I think 50% of the export into the US from India within the electronic sector is actually smartphones, and that percentage is only increasing with Apple and the other manufacturers increasing their output from India. Similarly, you have textiles, pharmaceuticals, etc. Some of these may be discretionary, some of these may be not so easy to address, and some maybe already seeing some impact all over the years. My sense is that steel and aluminum and other things, and may be easily addressed, and that's the first set of tariffs that we have seen for imports into US, steel and aluminum at 25%. But I think some of these will need to be seen in the light of how it will impact consumers, and what alternative does the US have within US boundaries, because shifting or increasing the tariffs from India, and not having actually the supplies from any other source doesn't help. So either you have an alternate source within the US and a competitive source from within the US, or you don't. I mean, on a weighted average basis, you can increase the tariffs, but not really on a product specific basis, which doesn't help the US consumer. So my sense is that even though there are differentials in terms of tariffs between the two nations, like you can see on the left hand side of this chart, of the slide, you can see the chart where you can see India's tariffs on US imports. A large percentage of it is actually, you can see that 48% and 13% is at a very high tariff rate, which is more than 10% and or maybe more than 9%. Correspondingly, you can see on the bar on the right hand side, the US tariffs on India's imports are actually India's exports to the US is actually at a very significantly low tariff. So 51% of the exports from India into the US go at 0% or close to zero. There is definitely a differential in terms of the tariffs between the two nations. And on the right hand side, you can see that a weighted average tariff on all products is actually about 9.5% import duty for India, for US into India, whereas when we export to the US, it's about 3%. So there may be a case of bringing it closer to the midpoint, which is quite possible. And as you can see here, there are three scenarios. The US might just ask for just bringing down the differential to zero and making it the same as part of reciprocal tariffs. It could do a middle path where both sides come down to a new rate and negotiate. And the third possibility is it just raises the rates in line with what India has. So clearly some segments like food products, for example, I'm told dry fruits tariffs are very high when US exports into India. Especially products like almonds, for example, come at significantly high tariffs. So if there could be a possibility of the tariffs being raised by India, by the US for the Indian products as well, to a similar percentage, and that will hurt. So as of now, the impact that we see on India, if reciprocal tariffs are announced and implemented, is roughly between the impact on the GDP would be between $1.5 billion to $6 billion, which is about 4 to 16 bips of impact on GDP. Of course, this will happen over a period of time. It will not happen immediately. There will be impact on demand and supply. So to that extent, some of it will get nullified or get worsened. We'll have to wait and see how that plays out. But at the moment, I think it is unlikely to be significantly disruptive for India. Of course, the big opportunity is also there. To my mind, I think there could be a significant shift away from some of the other markets like China. If this is an example, a case in point. This is electronics, import into the US from different countries, including China and India. You can see that 84% of the electronics goods requirement or demand from the US is met from China. So it's a significant dependence on China at this point in time. From India, it's about 10%. It's grown steadily in the last 3 or 4 years. I think with the large manufacturers like Apple, Samsung, etc., setting up bases and producing in large quantities, and with government incentives now exporting as well. So we are now 10% of the smartphone imports into US. And is likely to increase significantly further. I think the numbers for 25 is possibly 15% or so. And by 2030, I think this number is likely to be significantly higher. So there is a possibility for India, or an opportunity for India, to really scale up significantly if there are significantly high tariffs on other countries which compete with us, like, for example, China. So the 84% dependence, if that comes down to even 60 or 65%, there is a huge opportunity for India to take advantage of. And that is also something that excites us, because that helps our GDP. So, which is why I go back to the point I was making earlier, that there are lots of to and fro moves. I mean, there could be some gains and some losses. Net, over a period of time, we will be able to figure out exactly how much has been the net gain or loss to the GDP. So I think that's broadly on the tariff discussion.
Right.
We will see how this plays out over time.
Thanks, Vin. Thanks for
Yeah.
a comprehensive answer. So coming back to India, so India's GDP print is expected to be 6.5% for FY25. And obviously there are two ways which right now government is trying to spur the GDP is through push the basically the tax cuts which was announced in the budget, and then there is RBI is trying to get the rate cuts going, which will is expected to spur economy again and consumption a little more. But there are still huge amount of concerns on how private investments will pan out, how the government capex is expected to pan out. And do you think that we will be able to go back to about 7.5 to 8% on India GDP number? And what could be the probable measures to make that happen?
Yeah, so I think the Indian GDP was growing at a fairly high pace until the last calendar year. I think there's been a slowdown over the last 3 quarters, as we all know. The December quarter numbers was the worst, or sorry, the September quarter numbers was the worst. December, we've seen an improvement. There are two things to note here. One is that the first 2 years post-COVID, there was a recovery phase that for the economy, and that actually helped achieve numbers of 9% plus, and then that dropping to about 8.4%, etc. So there was an expansion because of a recovery phase from a pandemic, and that resulted in slightly elevated numbers for some period of time, and that normalizing over a period of time to closer to a 7% mark is what we were expecting. Now, calendar year 24, we saw challenges because of the elections first, given that most of the government agencies and the ordering agencies actually stop giving out orders, and there is there is a complete freeze on activity for a period of time, extending to before and after elections, and therefore, that impacted the numbers significantly for the last 1 or 2 quarters, or the first 2 quarters of the current financial year. Now, that included the capital expenditure from the government side, which was one of the key drivers of growth for the economy. Private capex has still not picked up in a big way, given that the capacity utilization on the whole for India as a country is at about 75%. But there are pockets which still need to utilize some capacities, and I think the consumption piece within the economy has not really recovered fully. We've had sticky inflation and high interest rates, etc., which have impacted the consumption within the economy. And Given that consumption was sluggish for long and continues to be this case, private capex has not really picked up in a big way. So both of these possibly could be reasons for private capex not having picked up in a meaningful manner. Obviously, when you say private capex, it also, the last phase between 2004 and 2010 included, a significant capex on private power capex, in, thermal capex that took place. This time, that is not there anymore. So on the thermal side, you're not seeing private sector come in a big way. There's renewables, but that's not adding up to the significant numbers that were there in the last cycle. But apart from that, the rest of the space is, pockets of them are improving. But suffice to say that private capex is still weak and has not really contributed as much. During this year, we've seen government capex slow down a bit, and that leading to the overall, numbers being slack. Government capex slowed down for obvious reasons, and then the monsoon quarter was bad. In many states, you had excess rainfall, and therefore that impacted activity again. My sense is, with the data that is coming through now, December numbers were good for, government capex. January numbers were very good for government capex. It remains to be seen how this goes, into February and March and going forward into financial year 26. My sense is on the base that we've had in FY25, capex is actually likely to be significantly better over the next few months and quarters. So FY26 capex should be, much better. We've not really achieved budgeted numbers for FY25. Some of that will get pushed into FY26. So I think overall, my sense today is that capex for FY26 is going to be reasonably strong. And therefore, my belief that the leadership within the markets, which was the capex related sectors, which really led the markets on for 2 years plus before this correction. That I think that theme doesn't fall off the tracks. That is still going as per on track, and I think the expectation, at least that we have, is that FY26 could be a reasonably better number from the capex side. On consumption, I think we are seeing some gains, as you rightly said. The government is now focused on consumption, so there's been a lot of SOPs that have been given through the budget and off budget during the elections, etc. So I think, and of course, the inflation numbers have cooled off quite significantly. That's a big relief. Just today in the afternoon, the inflation print for February was announced. That's come at 3.6%, which is a better than expected number. So I think the issue of high inflation is now getting addressed. That's a big relief. Interest rate has been cut. The RBI has been focused on liquidity. All of that is actually quite positive for the economy. And what we are seeing on the left-hand side is actually a slight improvement or improving trend in terms of GDP numbers as well. I think the expectation is that this year we would be at about 6.5% or so, 6.3, 6.4%. And next year, remains to be seen how the global side supports us and the export side fares. But apart from that, from a domestic point of view, I think you should get better growth in the next financial year. The government is also doing a lot of, I mean, a very focused effort on putting in a lot of focused effort on keeping the fiscal deficit under control, and therefore the debt to GDP numbers also are under control. And these are significantly positive. Again, I think the liquidity in the system has improved. There is less pressure, and for if private capex, as and when private capex improves, there will not be any crowding out effect, and the stage is set for banks to lend, given that the asset quality cycle is also quite at its best at this point in time. So, as you said, I think the uh, uh, stage is set probably for the GDP growth to again go back to a 6.5 to 7% range. Since you asked whether we will see 7.5, 8 like we've seen in the past, I'm not so sure that in the near term we'll see above 7% or 7.5% easily. I think that will happen only if the global GDP and economy picks up in a meaningful manner, and there's no disruption of any kind going forward.
Yeah, thanks. My next question is on whereas this market has corrected quite prominently over last 6 months. So, what's your take on valuations now, especially for each market cap, stocks in each market cap, which is large cap, mid cap, and small cap? And what is your preferred segment from a short-term perspective and a long-term perspective?
Yeah, I think markets have corrected meaningfully. The Nifty is down now from the peak of September, and by about 14% or so. The mid and small cap indices have corrected even more. The small cap index is down, I think, close to 24% or so from that peak. Small cap stocks are down 30 to 50% in this period, and I think the correction has been so swift and severe that it has taken everyone by surprise. And I think the excesses that were there in terms of valuations have reduced quite meaningfully. Why I'm saying reduced is because there are pockets which are still probably a little more expensive, and also one needs to be careful of the earnings growth trajectory and how much you expect for the next 2 years, given that you know it you can expect the domestic market to really do well, the domestic economy to do well, and give you that growth. But from a global perspective, there are still uncertainties, and therefore, one needs to be careful in projecting numbers for the next financial year and the year after that. I think the markets are slightly, more optimistic, and to that extent, I think the valuations may remain a little more. I mean, in pockets, a little, optically, it may look more expensive, and therefore, I think. One needs to be careful there. But otherwise, I think stocks have corrected. So you can see on this chart here, within the Nifty 500, which is a fairly large universe of stocks, 65% of stocks are down more than 20%. So 275 stocks within the Nifty 500 are down anywhere between 20 to 40%, and another 48 stocks in this universe is down more than 40%. So 65% of stocks within a large universe like the Nifty 500 is down more than 20%, and and or more, which makes me feel that a lot of the excesses have already got corrected. Very few pockets where the excess is still there. I think the large and mid cap valuations have also corrected at this in this period. You can see here that the correction has been close to median when you look at different phases of the market. You can note the different times when markets have corrected meaningfully, and how much we've already seen in this phase of correction in the last 5 months or so of decline. So clearly we have been close to, or we've come close to the median corrections in the market on a historic basis, and that again makes me feel that we are close to the bottom of this market fall. Since you asked about small and mid cap valuations as well, I think you can see that on this chart. The blended forward P is actually is down now for the both mid cap and the small cap indices. Though that is the case, they've not really come below or close to the 10-year averages or the long-term averages. There is still some distance away from the long-term average, but this is the index we are talking about. There are some stocks that have corrected more, some have not. So this is the at the index level. On the left-hand side, the chart is more important. I think the financial year 25 has been a challenge for the broad markets, given that the overall economy slowed down. There was high inflation, consumption didn't pick up, capex slowed down, and liquidity became tight towards the latter half of the financial year. So all put together, these were challenging conditions for the broad markets, the smaller companies, and that led to lower earnings growth for these companies for the financial year closing March. Um, as I earlier mentioned, a lot of these factors have changed, and therefore we are more optimistic on the next financial year. So I believe that the small and mid cap growth in earnings will again pick up fairly significantly into the next financial year. ROEs, you can see on the right-hand side, they continue to expand. Most of the parameters that are seen here, which are driving that ROE expansion, are continuing to remain there. Even if margins have peaked out, I think the expectation continues to be of low commodity prices, and crude oil is at a low point today. Interest rates are getting cut. Tax rates still continue to be very favorable for corporates. There are incentives for multiple sectors for production. And so ROE expansions, to my mind, is continuing here. And therefore, my belief and the initial address that I made, where I meant that I spoke about the opportunity to invest for the longer term. I think in the next few months, if the market continues to correct like this, it gives a great opportunity to invest. In the near term, given all the uncertainties that are there, if somebody is really focused on a shorter time horizon, maybe large caps, I'm tempted to say that large caps would be a favorable place or a better place to remain. But I'm still very positive and optimistic on the mid and small caps for a 3-year, 5-year time horizon. And with the correction that we have seen, I think they offer great opportunity.
Thanks, Venu. So, Venu, so next question would be on what are your, as a fund house, what are your top three sectors which you are overweight on, and top three sectors where you are underweight right now, and rationale for that?
Yeah, so I mean, see, the thing is that for the last 2 to 3 years, as a fund house, and most of our funds behaved in that manner, had a view that we were clear of the pillars of growth for the economy, and therefore what would drive the markets, what would drive earnings growth, and therefore the markets as well. It was easy to take a view on a theme, and therefore the sectors that can play out within that theme. Uh, Unfortunately, in the current scenario for calendar year 2025, that becomes a little challenging because you are seeing, a lot of the uncertainty play out, and therefore, taking a view on a particular theme or being significantly overweight a few sectors looks a little, I mean, to my mind, becomes a little bit of a difficult proposition. And we are seeing rotation of sectors almost on a monthly basis or even lesser time frame. For example, the IT sector for some period of time did extremely well, and I think given the results from from Q2 to Q3 and then to Q and the expectations of Q4 and going into the next financial year. The earlier expectation, maybe 3 months ago, was that the run rate is getting better. The exit run rate for the IT companies at the end of financial year 25 would be strong, and going into 26 would continue to improve with the large deal wins, etc. Suddenly, in the last week or 10 days, you've seen how this view is now getting challenged. Even if it's for a short period of time, it's getting challenged. And the problem today with the market is that you have, there is the time taken for stocks and sectors to re-rate or derate is getting crunched very significantly. So you see the impact of expectations on global economic slowdown or the US economic slowdown play out on the IT space, over the last few days. So the point I'm making is that it's not easy to really take a view for a slightly longer time horizon at this juncture. And therefore, in the calendar year 2025, my expectation and my ask to my fund managers also here is to be prepared to change your views, be prepared to wear your thinking hat, take decisions on the go. You just cannot live with one set of expectations and then let it be for a longer time period, which was what we've always been doing in the past, and we prefer that kind of investing. The current calendar year, there are uncertainties, and therefore you need to change and you need to move faster. You need to modify your views if required. So I would say that at this point in time, given what we have seen on the capex and the investment sectors for the last 2 years, and what has not happened on the consumption side, and with the SOPs and with the benefits that have been given from the government side, I think at some point in calendar year 25, and my belief is it will come probably towards the second half of the calendar year 25, the discretionary consumption space will pick up. The SOPs and the benefits that have been given from the budget and outside the budget by the government, along with the lower interest rates, will take time to really seep in, and with a lag will help consumption. Initially, it will be small ticket consumption, which means sectors like QSR or the retail sectors, small ticket consumption sectors, food and beverages, travel. Those are the segments that would take off, I think, first, with this gain that is there, and then followed by the bigger ticket items like automobiles and housing, etc. So I think, and real estate is a segment which has done extremely well. We think that that segment is likely to continue going forward as well, with the consolidation that has taken place, with the reforms in the platform for larger companies to perform and deliver and grow, being there, and the interest rates now getting cut. I think the situation is quite favorable for real estate. However, I think with prices having moved up, and with the current scenario, with markets having corrected, in the short term, there could be some pressure in terms of projects not going as per expectation. There were also some delays in approvals, etc., in some states, and that got pushed into 26. So, I mean, different sectors would have different scenarios. Currently, I think real estate is probably in a phase where it got slow a little bit. Maybe in another quarter it'll start picking up again, but we believe there is strong potential for that to expand going forward as well. The only sector we are not very positive on a structural basis is consumer staples. I think there are few challenges for the sector. I think the penetration of IT and quick commerce has been quite disruptive for the space, and And I think as per capita GDP rises, the excess money or the disposable incomes which from households will go more into aspirational purchases, and therefore I think the growth for consumer staples is likely to remain subdued, is the view that I have. Obviously, stocks have corrected, so you may get trading bets. So I think this year you will need to take those opportunities as they come, and depending on valuations and depending on the cycle, then keep changing from one to the other. The broad thesis remains that the investment cycle will continue, and discretionary consumption in the second half should pick up in a meaningful manner.
Sure, sure. Uh, so my next question will be on what's your view on dollar and INR, given that INR has depreciated quite a lot already, and views on RBI rate cuts.
Yeah, so I think the dollar started, appreciating, and the Indian currency they started depreciating from October. I think that's picked up pace. That was largely with the expectations of Mr. Trump coming to power and in the US, and then the dollar index appreciated. The initial reaction of the US market and the investors there was quite optimistic, and with the view that the US economy is likely to expand, and um, that's a better market. Obviously, that also got helped by the Magnificent Seven and the progress or the noise around AI and things like that, which resulted in flow of money into the US markets. The dollar index appreciated against other currencies, and bond yields also started moving up. My sense is that trade has played out. Now obviously the view is has reversed a little bit. Now people are believing that growth is slowing down, and in fact, a lot of strategists and generally people are talking about whether a recession is possible. So from one extreme to the other extreme is what I think. I don't believe that those extremes will happen. I think there will could be a slowdown, which means that you have seen the dollar appreciate, and now it will come back to its earlier level. So I think the pressure on the rupee has reduced. I think with the domestic economy getting better and the US economy slowing down, the differential in terms of growth will also play a role. And to that extent, I think the currency could become more stable as we go forward. And we've already seen a depreciation, a steep depreciation for some period of time, which is how it plays out. For a long period, it remains quite flat, and then something or the other, some variable changes, and then you see a sharp depreciation, and then again it moves sideways. So I guess that's where we are. We've seen that sharp depreciation phase now. A lot of the factors that led to that depreciation is already factored in. Some of that is changing. So I think the worst in terms of depreciation is probably there for you. I think the forex reserves also are fairly strong. We have seen some of that getting used for currency, protection of the currency or stabilizing the currency. Um, I think that again should come back. What has been used should again come back over time, and this augurs well for the economy. And I don't see too much of volatility with respect to the currency, at least from here on. Given that what we've seen the worst in terms of expectations play out, and now a reversal of that happening in the US.
Sure.
On the
And
interest rate side, yeah,
uh,
on the interest rate side, since you asked, I think the expectation from the RBI is also that inflation will moderate even further. So we've seen a good print in February. I think that's better than expectation. For the next few quarters also, it is expected to be fairly benign. Crude oil prices, as I mentioned earlier, as you can see in this chart, Brent crude price is close to $70 now, with all the expectations of US, increasing production. And if there is a, any kind of resolution of the conflict between Russia and Ukraine, oil supply can actually be higher. which makes me feel that overall inflationary pressures will be limited, and which will help the central banks ease policies and lower rates. So my expectation is another 25 basis cut in the April policy, and maybe more coming in the second half of the year.
Thanks, thanks. And now, so we know what's your views on commodities, especially the precious commodities like gold and silver, and some of the key industrial commodities like copper, because that defines really the obviously gold and silver has run up quite significantly over a period of time as a geopolitical hedge to geopolitical risks and inflation. But what's your view on these commodities now?
Yeah, I think gold is actually a play on protecting your investment value against inflation. I think and uncertainty. So I think you had a fair bit of that, and of course the fundamental aspect was also that the central banks were across the world were buying more of gold for their as part of their treasury or the book. And to that extent, I think the gold prices have gone up, given the uncertainties that persist, and in the current calendar year. You might see that trend continuing for some more time, but my sense is that we have seen the best in terms of the upside there, and as and when these uncertainties slowly get to at the end, I think you will see that also playing out meaningfully. Um, Industrial metals is at a very low end at this point in time. Prices have cooled off and are at low levels. There is not too much of demand to take prices higher. Obviously, these tariffs that have been announced will result in some disruption. For example, you in the US, we've seen already price increases for steel, um, and therefore, the domestic producers becoming more competitive now. So we will wait and see how this plays out, because there is a lot of there could be a lot of shift between especially for these metals. There could be a shift in terms of supply, and it all depends again on how China progresses in terms of growth, whether the stimulus and the government actions can really help stabilize the economy and improve growth. A lot depends on that in the real estate sector in China. So, difficult call to make. I'm not too bullish on these for the near term. However, from these prices, possibly, again, like I said, for consumer staples, I mean, there could be a possible valuation play there, or a trade there for in this calendar year, which may come. But apart from that, I can't see too many factors which are favorable on from a demand supply point of view on a fundamental note.
Yeah, thanks, Venu. Uh, I guess we have used up all the time, and thank you for joining us today. It was a wonderful insights for our viewers. Thank you everyone for joining us today. Have a good evening. Thank you.
Thank you.